Welcome back to the channel, everybody. Today, we are pulling back the curtain on a hidden $14 trillion market that quietly controls almost every single financial decision you make. While financial news endlessly obsesses over tech stocks and volatile crypto charts, the massive bond market is nearly 3 times larger and acts as the true underlying engine of the global economy. Whether you are looking at your current mortgage interest rate, checking the annual yield on your high-yield savings account, or tracking your future pension fund, bonds are silently pulling all the levers behind the scenes. Yet, despite powering the entire financial system, most everyday investors have absolutely no idea how a bond actually functions or why it matters to their personal wallet. Maya is about to discover that understanding this giant asset class isn't just for Wall Street institutions. It is the ultimate cheat code for protecting your long-term wealth. Let us break it down.
At its core, a bond is surprisingly simple. It is just a formal IOU note. When a government or corporation needs cash, you lend them money. And in return, they promise to pay you back with fixed, regular interest payments, called coupons. But here is where almost everyone gets confused: the inverse relationship between bond prices and yields. Think of it like a playground seesaw. When central banks raise prevailing interest rates, newly issued bonds start offering higher payouts. Earnestly, older bonds paying lower fixed interest become much less attractive to investors on the secondary market. To sell that older bond, its market price must drop until its overall return matches the new higher market rate. Conversely, when interest rates fall, those older high-paying bonds become gold dust, driving their market prices sky high. Maya realizes that price and yield always move in opposite directions. When interest rates go up, existing bond prices go down.
Now, here is where investors get caught completely off guard: duration risk. Duration measures how sensitive a bond's price is to changes in interest rates, and time is the multiplier. Imagine Maya holding a heavy weight attached to a long wooden stick. If she holds the weight right near her hand, a slight twitch barely moves it. That is a short-term 2-year bond. But if that same weight is strapped to the far end of a 10-foot pole, representing a 30-year bond, that exact same tiny twitch at her wrist creates a massive, uncontrollable swing at the tip. In financial terms, if interest rates suddenly jump by just 1 percentage point, a long-duration bond portfolio can easily lose 10 to 15% of its market value instantly. That single rate shift can completely wipe out years of accumulated coupon income in a heartbeat if you need to sell early.
While stock market traders panic over daily headlines, sophisticated institutional investors watch a far cleaner crystal ball: the bond yield curve. Normally, lending your money to the government for 10 years pays a higher interest rate than lending it for 2 years, because longer time carries more risk. But occasionally, something strange and ominous happens. Nervous big investors start flooding into long-term bonds for safety, driving long-term yields down. At the same time, short-term yields spike. This creates an inverted yield curve, where short-term debt pays more than long-term debt. Every single U.S. recession over the last 50 years has been preceded by this exact inverted signal. While stock markets often rally near economic peaks, the bond market quietly sniffs out upcoming recessions months in advance. Maya sees that bond investors aren't guessing. They are pricing in economic reality long before equity markets catch on. It remains the ultimate early warning radar for smart money. For decades, financial advisors preached a golden rule: the traditional 60-40 portfolio, placing 60% in stocks for growth and 40% in bonds for safety. The theory was that when stocks crashed, bonds would rise to cushion the blow. But in recent years, especially during high inflation shocks like 2022, that holy grail completely shattered.
As central banks aggressively hiked interest rates to fight surging inflation, both stocks and bonds plummeted side by side. Investors holding classic 60/40 portfolios suffered double-digit losses in both asset buckets simultaneously, leaving them with nowhere to hide. Maya realizes that relying blindly on old asset allocation rules without understanding interest rate regimes is a major trap. Bonds still provide essential stability, but holding them passively without managing duration can ruin your safety net. Today, smart investors build active bond ladders and mix short-term treasuries to protect against unpredictable market shifts and inflation spikes. So, how can you actually harness the $14 trillion bond market to build a resilient, bulletproof portfolio? First, stop treating bonds as a boring afterthought. Instead of buying generic, unmanaged funds, consider building a strategic bond ladder, buying individual bonds that mature at staggered intervals so you continuously roll capital over into higher available rates. Second, pay close attention to short-term treasury yield rates as a benchmark for your cash, ensuring your bank is not skimming off your interest savings. Third, utilize treasury inflation-protected securities whenever rising prices threaten to erode your true purchasing power over time. Maya now realizes that bonds are not static or dull. They are dynamic financial levers that grant you predictable cash flow, portfolio defense, and clear macroeconomic foresight. Once you master how yields move, you stop panicking during market swings and start orchestrating your financial future with supreme personal confidence and total clarity. As always, appreciate you hanging out today. See you in the next one.